So this question is multi-part in respect of financial instruments. It's a question called Aron from the BPP revision kit. So we start off with part A. As far as part A, it says briefly discuss how the fair value is measured. So pick up the requirement, and what we would say here is per IFRS 13 there are 3 levels of measurement when determining fair value. And it would be acceptable to put FV in an exam answer. The markers aren't going to think, oh, FV is a fair value question. What could that stand for? Yeah, it's not going to happen, folks. So level 1 is where we have identical assets being traded in an active market. So e.g. this could be a stock market. Such as Wall Street. All shares are identical, aren't they? So therefore we can pick up the fair value by saying, well, what is the closing price on a particular day? Level 2 is where we have identical assets being traded on a non-active market or similar assets on an active market. So here we might have some stock market for non-listed companies where there is some type of activity, but there's not enough to be an active market. Level 3 is where we have what we refer to as unobservable inputs, e.g. management calculations on a spreadsheet. So if possible, you will try to measure an asset using level 1, if not then level 2, if not then level 3. Depends on the nature of the asset. So if I had a specialist piece of machinery, well, the chances are that I'd probably have to use a level 3 approach. I'd have to get management to do some cash flows in relation to the asset, discount those back to try to determine some form of fair value. So that is the first part of part A. It then says, commenting on the relevance of fair value measurements for financial instruments where markets are volatile and illiquid. Per the framework, financial information should be relevant and have faithful representation. So the information we see in the accounts should satisfy both of those. There is a trade-off between the two characteristics. If markets are volatile, the values used may quickly be out of date. If you think about share prices, they can rise and fall very, very quickly, which can cause that information to lose relevance. So this reduces the relevance of the values. So I'm trying to pick out the words from the question. Notice that the question has the word "and" in it, volatile and illiquid. If markets are illiquid, then there are few transactions and the accuracy of the last recorded values is called into question. However, on balance, fair value is more relevant than the major alternative, which is cost. Because cost is even more out of date than the fair value at the last SFP date. So what I've written there is going to get far more than 4 marks, because when this question was originally written, it was before IFRS 13. So I've actually given you a little bit of background here in respect of IFRS 13. Let's now turn our attention to part B of the question. And for part B1, is in respect of our convertible bonds. As always, dates in questions are very, very important. Notice that these bonds were issued on the 1st of June X5, and it is now the 31st of May X8. The bonds should have been split between debt and equity at the issue date of the 1st of June X5. We initially measure debt by discounting at the rate charged for a similar non-convertible instrument. Now, what I'm going to do here is slightly different from the BPP textbook, but it does actually give you the same answer. Let's just read. That's charged. Let's just read what happens. We have issued bonds for a value of 100 million, and we've incurred issue costs of 1 million. So we've received 99 million. And we're told in the final sentence that the impact of the issue cost is to increase the effective interest rate to 9.38%. So what I'm going to do here is, step one, I'm going to discount the cash flows by 9.38%. So what are those cash flows going to be? Well, on the 31st of May X6, it's $100 million, paying interest at 6%, and I'm going to discount that by 9.38%. At the 31st of the 5th X7, 100 million times 6% means that there's interest paid of 6 million. Discount that by 9.38%. Gives us 5.02 million. And at the 31st of May X8, this is going to be the current date, we assume that we repay the capital of 100 million and we pay the interest of 6%. So I'm going to discount that for 3 years. That gives 81.00 total. So that gives a grand total of 91.51 million. Step 2, we calculate the equity. As the residual figure. So here I'm going to debit cash I'm debiting cash. We've received a net 99 million. Credit liability, because remember that's 100 million less the 1 million issue costs. Debit the liability 91.51 million and credit equity with the balancing figure of 7.49 million. Okay? And those figures are almost identical to what you've seen in the BPP textbook, but this just cuts out one of the steps. This is actually a more efficient method. And the only difference between my approach and the BPP one, there's just a couple of rounding differences. So the actual numbers are identical. Step 3, we need to calculate the bond at the SFP date. So date, when were the bonds issued? 1st of the 6th, X5. How much have we borrowed? 91.51. What's our interest going to be? It's 9.38%. And what's the cash going to be? The cash is 6 million. So our liability at the end of the first year of the bond is 94.09. Interest in the second year is 8.83. We're going to pay cash interest of 6. And can you therefore see at the end of the third year, where we are currently, the bond has a value of 100 million at the 31st of May X8. Yeah, you've got to use the effective interest rate in the interest charge which arises in the income, because that's what the amortized cost method says. It's to use the real rate of interest rather than the nominal rate of interest. And if you think about it, we've not actually borrowed 100 million. The $1 million worth of issue costs is a cost which needs to be spread over the life of the bond, and the way to do that is to embed it into the interest. You wouldn't have lost many marks by putting in 9%, because at least you've shown you know the broad principle, but can you see that you would have ended up, yep. So at maturity, all of the bonds were converted into 25 million ordinary shares of Aron. So step 4, we convert the bonds into shares. So therefore, we're going to debit the bonds $100 million. How many shares have we created? 25. So we're going to credit share capital $25 million, and we're going to credit share premium $75 million. We can also transfer the figure in equity into share premium. So remember, we created this equity figure here of 7.49 million. So what I'm now going to do, I'm going to debit equity 7.49 million and credit share premium 7.49 million. So that's note 1 dealt with. Quite a lot to deal with there for 6 marks. But it is a process which you can follow. We now move to part B2, which represents the shares in Smart. It says the investment was classified as an investment in equity instruments, and we had a carrying value of 5 million brought forward. We've made an election to recognise all gains in OCI. The cumulative gain on the 31st of May X7. Look at these dates. Dates are really important. On the 31st of May, the whole of the share capital of Smart was acquired by Given, and as a result, we received shares in Given. So what we would say here is that Aron needs to de-recognise the investment in Smart because it no longer has the risks and rewards of ownership. At the same time, Aron should recognise an investment in Given because it owns the shares and has the risks in relation to that ownership. The fair value of Given shares is $5 million. And so how do we deal with this? Well, I'm going to debit my investment in Given at the fair value of 5 million. I'm going to credit my investment in Smart oh, sorry, that should be 5.5 million. How much was the investment in Smart? The investment in Smart was in the books at a value of 5 million, and we're going to credit OCI. Why? Because we have made an election to recognise gains and losses in OCI. So that's going to be gain on Smart of 0.5 million. Because Aron no longer owns Smart, it can transfer all the gains to retained earnings So what are we going to do? I'm going to debit other, or OCE, other comprehensive equity, or other components of equity, remember we have previously recognised gains of 0.4 million in OCI, which flows through to OCE. So my total gains, which have gone through OCI, are 0.9 million. So I'm going to debit OCE 0.9 million and credit retained earnings. £0.9 million. So this is more of a narrative discussion, but again, what I've tried to do bit by bit, step by step, I think I've got enough points in my answer to generate 4 marks. Probably more than 4 marks. Item number 3. We've got our wholly owned subsidiary, which is called GAO, whose functional currency is the zloty. Zloty is the currency in Poland, or used to be the currency in Poland. GAO owns a debt instrument which is held for trading, and we're given the differences to the value. The value's gone from 10 to 12 million. And it says in the requirements the company wishes how to account for this investment in GAO's financial statements and the financial statements of the group. As soon as I see the word "and," it's telling me there's 2 questions here. So first of all, I'm going to deal with it in the books of the subsidiary. Because the investment is held for trading, and if it's held for trading, it fails the business model test, doesn't it? Because the business model test says hold on a long-term basis. So because the investment is held for trading, we use fair value through profit and loss to measure the asset at the SFP date. So therefore I'm going to debit my financial asset. It's now worth 12 million. It was in the accounts at a figure of 10 million, so it's going to be 2 million zlotys. And I'm going to credit the income statement of GAO with that 2 million zloty gain as well. So I'm breaking the question down, as always, into components, and then we've got the group accounts in the consolidated SFP we measure the instrument using the closing rate of exchange. So at the 31st of May X7, what we would have said is it's valued at 10 million zlotys, and there are 3 zlotys to the dollar. So it's $3.33 million. At the 31st of May X8, the value is 12 million zlotys, but the exchange rate is now 2 zlotys to the dollar. So its value has increased to 6 million. So we have an exchange gain, sorry, we have an overall gain, not an exchange gain, we've got a gain in value of $2.67 million. Now, can you see we've got a slight problem here? Part of this gain is due to the value of the debt instrument going up, and part of the gain is due to a movement in exchange rates. In the group income statement, we will show the gain in the investment value of 2 million zlotys using the average exchange rate. Of $1 equals 2.5 zlotys. This gives a gain of $0.8 million, because it's 2 million divided by 2.5. Therefore, our journal is debit debt instrument. How much has the debt instrument gone up by? It's gone up by $2.67 million. Credit income statement, $0.8 million. We've just done that calculation. And the remainder of the increase in the value of the investment is taken to OCI. Remember, when you consolidate a foreign subsidiary, currency gains and losses on translating the assets and liabilities of the subsidiary go to OCI. So that's going to be the balancing figure. It's 1.87 million. Next, we've got part 4. Part 4 is our employee loan. So what have we done? Well, we've given our employees $10 million. And we're going to get that money back in 2 years as a single payment. The market rate of interest for a 2-year loan is 6% per annum. So what we should say here is at the loan date of the 1st of June X7, we measure the loan at the present value. Why? Because we're using the amortized cost model. Why are we using the amortized cost model? Because under IFRS 9, the business model is to collect the cash, and we have contractual cash flows. We've got a specified amount on a specified date. So this is the amortized cost model. How much are we talking about? It's $10 million. We're going to discount that at 6% for 2 years. So that works out as $8.9 million. The remainder of the loan is treated as an employee cost. Because what are we doing? We're giving them a benefit, aren't we? But we're lending them money at a cheaper rate that they would normally expect to pay. So this is an employee cost to us. So therefore, let's convert that into a journal. Let's credit cash. $10 million has gone out of our business. We're going to debit a financial asset, $8.9 million. And we're going to debit the income statement employee cost, $1.1 million. But we're going to receive, we're not going to get $8.9 million back, are we? We're going to get the full $10 million back. We recognise interest on the loan at 6% in the year ending the 31st of May X8. So therefore I'm going to credit the income statement $8.9 million times 6%. This equals $0.53 million, and debit our financial asset. $0.53 million. So that's how to deal with part 4, and we've now dealt with every element of the question.